Well, hey everyone, a little bit earlier than usual, but we are here live for Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a beautifully sunny and comfortable Redmond, Washington. Hope you guys are all doing well wherever you're at as we wrap this fascinating market week of elevated tariff tantrums, of further question marks, but a resilient market not too far off of all-time highs for the major equity averages. Friday, we like to do an all mailbag episode, which is what we will be doing today. I hand-selected 6 questions or so to go through with you. These are all questions we've received here, mostly in the last week, from all of you watching the show live or watching the replay on our YouTube channel and throwing questions there. So please keep them coming. It helps me so much to just see what you guys are running into, what questions you're struggling with, helps me to shape the content. Also gives us some really cool things to talk about here on a Friday afternoon. What we're going to do is do an abbreviated market recap, just checking in on how things closed out on Friday. I save a lot of my big analysis at the end of the week for my premium members. So a great time, as always, to be a Market Misbehavior premium member. We do a weekly flight plan every weekend. That's my main report as we look back at the week that just happened. We look forward at the week to come. So it's probably the most important time I spend every week as an investor. And I like to share those insights and key takeaways with my premium members. You can find more info at marketmisbehavior.com/premium if that's something you're keen on checking out. And by the way, make sure you use the code YouTube when you do it. You'll get a special deal on your first 12 months on any of those plans that you see. With that in mind here, let's look at how the market's traded today. Risk-off day of sorts here. You can see mid caps and small caps down the most. The S&P 600 small cap index down just over 1%. The S&P 500 down about 1/3%. It wasn't a horrible day, but coming off of yesterday's sort of rally phase, down about 1/3%. So the S&P closing just below 6260 for the week. VIX actually creeping higher, and VIX has been steadily drifting lower through the course of this week. So we're still in a low volatility environment. The VIX did almost get to 17 out of the open today, but still remaining kind of in that classic low volatility environment as we would describe. Rates generally moved higher today, particularly the further out you get on the yield curve. The 10-year point finished just around 4.4%. That is the 5-year point just below 4%. Specifically, the long bond yield just below 5%, kind of getting closer and closer to that as the day went on, as bond prices sold off. The dollar index, not much of a change, to be honest with you, did go slightly higher in the ETFs. We're using the UUP, which is a bullish dollar ETF. Gold and silver prices continuing to improve. Once again, we see silver outperforming gold. That is a phenomenon we addressed earlier this week on the show. It's continuing to happen where, gold's still okay, silver just a lot better. And if you look at the relative performance or the ratio, the silver to gold ratio, by far silver outperforming gold here in the last month. So overall, that seems to be a more encouraging place to be within precious metals, although I would say both of them in pretty good shape. Energy prices generally moving higher today. You can see crude oil prices drifting up, natural gas prices as well. Energy ended up being the top performing sector today. All right, cryptocurrencies had a really good interview with Adrian Zadunchik, who is a crypto pioneer, I will call him, but runs a crypto community called the Burb Nest, which he started years ago. Had a lot of fun asking him all sorts of questions about cryptocurrencies, Bitcoin dominance, Bitcoin ETFs, why he's thinking about unwinding his position, or at least lightening up on his position in Bitcoin, some of the seasonality tendencies, and so much more. That interview should be out to you pretty soon here, still with the editor, but will be worth the wait. Look for that over the weekend. We'll probably get it out to you hopefully tomorrow. My latest episode of the Market Misbehavior podcast, by the way, with Victor Hagani. Victor is one of the founding partners of Long-Term Capital Management, the infamous one, that incredible hedge fund launched with a bunch of former Salomon Brothers traders like Victor, Nobel Prize winning economists, all of that. And it couldn't lose, right? Could not miss, and ended up being one of the most colossal explosions or implosions, I guess, in financial market history. Caused quite a strain on the financial system. Great lessons learned, and a lot of great investment wisdom from Victor. I was super excited to interview him. That is out on our podcast. Check it out. All right, let's look elsewhere here. So Bitcoin, by the way, pushing all-time highs, did barely get to 119,000 for the first time in history. Not quite there, but almost there earlier today. All right, energy is the top performing sector today, up about 0.5%. Consumer discretionary number two, basically flat for the day. The rest of the stock, the S&P 500 sectors, all in the red. So in terms of sector breadth, not a great day here. You can see the major averages were slightly lower. You can see the sectors were mostly down. The breadth conditions, which we'll get to in a minute, not particularly good. Financials, the worst performer, down about 1%. Healthcare and materials, both down about 0.8%. We're getting close to earnings season, which should be kicking off here very, very quickly in the next week or so. Earnings, I think, are going to be crucial. So much speculation about the impact of tariffs. A lot of people, I mean, just a post I saw earlier today on LinkedIn, someone posted something about the potential impact of tariffs. And the comments, one by one, would be completely on two different sides of this question. One comment saying tariffs are going to be the best thing that ever happens, and here's why they're going to be so great, and here's what it's going to do. Then the immediate next post, and we haven't had any sort of negative reaction to the market. The market's recovered. And then immediately after that, it was, yep, it's just delayed. A lot of companies have been working through their inventory, but the pain is going to be felt. Just watch here. It's coming any day. I mean, this is how polarized we are in terms of just assessing the potential impact of tariffs. This is very much an uncharted territory, pun intended, about something like tariffs. Right? I mean, this is something none of us have seen in our lifetimes. You have to go back a little deeper in U.S. market history for the last time we had tariffs of this level of severity. So we'll see. But a lot of smart people I know are struggling to sort of figure out exactly what the impact will be. Let's let the charts tell us. For now, charts telling us don't be too worried. That can change. That's why we're going to keep doing the show every trading day and see what we can track. I mentioned the breadth not particularly great. You can see that the S&P, the NASDAQ, the New York Stock Exchange, way more stocks down than up. On the New York Stock Exchange, 71% gain decliners, that is 27% advancers. In the small cap space, severely negative, over 80% of the S&P 600 small cap stocks moving down today. So still too early to declare that like a huge disaster, but certainly something to keep an eye on. You can see kind of mixed bag here with the Magnificent Seven and Friends. Alphabet up almost 1.5%. Amazon up 1.25%. Meta down 1.33%. I think this group of stocks we've mentioned for quite some time. This is a key group to watch because of the weight they have in our benchmarks. I think going forward, it's going to be vital because even if a bunch of companies start reporting underwhelming earnings, if names like Alphabet and Meta and Broadcom and Microsoft and Nvidia are still doing well, the benchmarks are going to hold up pretty nicely because they are a huge weight in the benchmarks. If these stocks are struggling, though, it's going to be hard to imagine the benchmarks doing quite well. So we do have the S&P making a new all-time high on an intraday basis on yesterday's session. Today, just slightly lower. So overall, this week, coming off of Friday's gap higher, we're sort of treading water here, right? Look at where we're at today going into the weekend and where we were going into the going into the long holiday weekend last Thursday, just before the 4th of July holiday. We're basically right within that day's range. So from that gap higher, from that point on, we haven't really made any additional gains to the upside. We haven't really broken down a ton. And I think that's the setup going into earnings season, all right? A chart of the S&P and the NASDAQ that has been remarkably strong. Our market trend model remains fairly constructive on most global equity indexes. Do earnings support that? Do we see any of the language in earnings suggesting this tariff disaster that many people have been speculating is going to come at some point? Do we see signs that companies are starting to really have to reflect the impact of tariffs and what that could do to their supply chain, to how they're pricing things for customers? Those are all, I'm sure, the questions that we will get, hopefully get answered, but certainly get addressed on upcoming earnings calls. All right, that's it for the market recap. Let's go to question number one. Bob Farrell, one of the true masters. I mean, one of the legends in technical analysis. A master technician, as you say, at Merrill Lynch for several decades, once said the best bull markets tend to climb a wall of worry. Your thoughts? Well, my first thought is Bob Farrell is an absolute legend. And I knew of Bob Farrell long before I met him. I finally met him a couple years ago at the CMT Association's 50th anniversary in New York. I wish I had a picture readily available. I should have that queued up, but I don't. But I finally got a chance to meet Bob and ask him questions, interview him a little bit, and just it was just so fun to be able to talk with him and just and hear about his experiences. I had known so many people who had worked with Bob and for Bob over the years. I mean, anyone who kind of came through that Merrill Lynch, advisor community heard of Bob and heard, from Bob regularly as part of his work. At one point, Merrill Lynch had a huge team. It's now a much smaller team, unfortunately, but Bob was one of the true masters. So what does that mean? The bull markets tend to climb a wall of worry. 100% right. And this is something we used to throw around in my Fidelity days all the time. I mean, the quote that really, that I think of when anyone ever talks about the market climbing a wall of worry, what that means. It's a John Templeton quote. Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. And this is kind of what Bob Farrell was talking about with that quote, right? And when you think about any market, but think about the S&P as an example, right? The beginning of a bull market really begins when things look absolutely horrible, right? They're born on pessimism because the beginning of the bull market is really tough to pinpoint because everyone's so negative, right? Walter Deemer, legendary technical analyst at Putnam in the 1970s, would say, the time to buy is when you don't want to, when you can't imagine buying stocks because they seem like such a bad idea. That's usually the time you want to start to buy. Buy when there's blood in the streets is another famous quote talking about the beginning of bull markets. But as they begin, it grows on skepticism. I remember being incredibly skeptical in late April of 2025. I will go back for years and review that V bottom and how I interpreted all the different movements. I remember being incredibly skeptical, thinking about dead cat bounces, and this is just a pause before the next leg lower, because it just certainly felt like there's so many reasons why that downtrend could and most likely should or would continue. So they grow as investors are skeptical, but as they continue, right, that skepticism is climbing the wall of worry, as Farrell talked about. But they mature on optimism, and I think that's one of the things I'm picking up on right about now. I'm seeing a lot of optimism. I'm seeing a lot of people saying that was it. We're back to the bull market of 2024. We're going to go lights out 7K here. I'm getting that vibe from a lot of people. I definitely don't share that sort of unbridled optimism. I feel like we still haven't had the experience that we probably will in terms of digesting all of this new tariff stuff. I just think that the impact is going to be is more significant than what we saw in March and early April. So they mature on optimism, right? Investors start to get really optimistic. We saw the AAII survey last week get incredibly bullish, back to 2024 levels. They die on euphoria. When people are euphoric, when people can't imagine the market going down, that's usually the end. There's some really good books sort of building on that sort of general set of thinking about the behavioral aspects of different phases of the bull market. One of the ones I'm pretty sure is on my recommended reading list, which you can get to at marketmisbehavior.com and click on reading list at the top. It's called Bull, and I forget the author. I should know that, but basically, talks about the 1980s and specifically the 1990s, the bull market euphoria going into the tech bubble peak. I would encourage you to read that because there's so many similarities to how we are justifying valuations today, similar to what we saw in the mid-late 90s kind of era. So long story, those are my thoughts, I guess, extended thoughts on that. Long story short, Bob Farrell was a master. I think that is a brilliant way of thinking of it. Markets rally and there's a ton of skepticism. That's pretty classic with it. Get worried not when there's skepticism. Get worried when you don't hear skepticism anymore. That's when a bull market is usually in its later periods. Question number 2: why do you use the McClellan oscillator with ticker $NYMO? That's a stock charts ticker instead of exclamation point MC of that. Your charts normally follow the SPX, so why use a McClellan oscillator chart for the New York Stock Exchange? Oh, I see what you're saying. Yeah, this, let me show you what that is. So if we go here, here's the McClellan oscillator, and this is the one I normally use, NYMO. And what you're saying is, let's see if I can not completely destroy my chart. on a live stream and actually do something right. So let's say MCOSIRSPX. Yeah, so that is a basically a McClellan oscillator created off of the S&P 500 data. Let me organize this just briefly. We'll see if I can make these look kind of similar. That's not bad. I'm getting there. Okay, and then we'll make this kind of big. All right, that's as good as I want to tinker with. All right, so what I did is this is the McClellan oscillator I normally look at. This is basically a McClellan oscillator calculation, but instead of applying it to the New York Stock Exchange, which is what Sherman McClellan originally did, it's applying it to the S&P 500 names. And then here's the S&P at the bottom. So the short answer is, the McClellan oscillator, by definition, was an indicator created by Sherman McClellan and his wife, Marion McClellan. I interviewed Tom McClellan. Actually, I had breakfast with him last year at some point. He lives in the Seattle area, more toward Tacoma, and caught up with Tom over breakfast. We talked about a lot of things, and I asked him, give me the origin story of all this. And actually, I did interview him for my podcast, probably end of last year, I want to say. And he shared that story. So check it out on my YouTube channel. You can get to it. It's a fascinating story about being a technical analyst in that era and how the work was promoted and why the McClellan oscillator became so widely followed. It was a really interesting story. I hadn't heard all the details before, but he basically used New York Stock Exchange advanced decline data, and the McClellan oscillator basically turns the raw advanced decline data into an oscillator by looking at two different exponential moving averages of the raw cumulative advanced decline data. So he designed it based on the New York Stock Exchange. I still use that same calculation. Now, it's ratio adjusted, which is just a way of normalizing the values over a longer period of times, but it is in all essences very similar to the McClellan's original work creating this indicator. Now, you can adapt that same calculation to a bunch of other things. So you could look at it on the S&P 500. I mean, if you look at these two series, I would not say they are dramatically different. They certainly have some subtleties that are different between the two, but in essence, they're giving you the same thing, and so that's fine. For me, for breadth data, the larger universe you can look at is probably the best, which is why a lot of breadth data is on the New York Stock Exchange. It's on a much bigger group of stocks with a lot more different types of names reflected, because these indicators are equal weighted. So by looking at a bigger universe and equal weighting all of them, you kind of get away from the mega cap influence of the big Magnificent Seven stocks. You look at a broader universe, and then you can compare it to whatever index you want. I mean, McClellan's work didn't say, look at the McClellan oscillator and make sure you apply it to the S&P. You could look at the New York Composite Index if you like. For me, it's just, this is what the breadth is, and this is what the market is, and that's why I'm making that comparison. Having said that, on platforms like stock charts, there's a lot of really cool breadth indicators. And again, if I wanted to look at a lot more, I would probably, you can go crazy with the number of different breadth techniques you can try to use. So the short answer is, I'm trying to stay faithful to Sherman McClellan's original work, which I thought was very interesting. I already look at the New York Stock Exchange advanced decline line as my main breadth reading. And so looking at the McClellan oscillator, I think using that same data makes it consistent when I'm looking at questions of breadth. I'm curious if those of you have found a different breadth indicator like this is way more helpful. Let me know. Let me know which one you look at. But that's why I use that particular one. Thanks for asking about it, by the way. Next question. I use the Stochastics Momentum Index a lot. That's one I've not heard a ton about, but I'm familiar with it. Like, you use RSI. Can you use the SMI like the RSI? There's a lot of acronyms there, to spot bearish momentum divergences. Yeah, so my primary platform is stock charts. They do not, I believe, have the Stochastics Momentum Index, although I have seen it and I'm familiar with it. The Stochastics Momentum Index is basically, well, let me do this. So this is, let's see, here's Apple, here's RSI, and then at the bottom, I'm going to add stochastics because this is one of the things you asked about. So what stochastics does, the idea with the stochastics indicator is it's looking at where we are trading right now, where we close versus the high and the low for a period of time. So the initial comparison here by using this number 14 basically means I'm looking at the last 14 days. Where are we at right now versus the highest high and lowest low over the last 14 days? So it's all based on where we're at versus the trading range we've been in over a certain look back period. And then these other numbers are basically smoothing effects. So you smooth that out by 3 days, and that's the black line. You smooth that percent K line by 3 days, and that's the signal line or the percent D line. And you're looking at when they cross. You can look at divergences to answer your question. Absolutely, you can. So what you're using when you use the stochastics momentum index, it's the same idea. It's supposedly like an improvement on stochastics, which was popularized by an analyst named George Lane years and years ago. I don't know who created the stochastic momentum index, but if I remember right, instead of looking at the close versus the high and the low, it looks at the close versus the midpoint as one of the differences. And then there's some other stuff with smoothing, but at the end of the day, the indicator will look very similar to this. And the short answer is absolutely. You can look at divergences, you look at crossover signals, all the ways you would use stochastics. It's attempting to be a bit of an improvement on that. Now, I guess a larger point to make is, I feel like so many times traders and investors try to find that one indicator, right? Okay, I found stochastics momentum index. All of a sudden, this whole game is going to be super easy, and I just need to follow it. It's the holy grail effect. And I wish I could tell you, here's the one indicator you need to find. And I will tell you, a lot of people will unfortunately insist that they found it. I don't think that's true. There is no perfect indicator. There's no holy grail. There's no one thing that you just need to follow and it works. What I've learned is that technical analysis is combining a number of different inputs in a consistent way. That's how you do it. That's how you do it well. So if stochastic momentum index makes sense to you, and if the signals you see reflect how you're trying to trade certain markets on certain timeframes, you should use that. I would caution you about using too many similar indicators. So do you need RSI and stochastics and the stochastic momentum index? You definitely do not. I would pick one of those and just use it consistently. So out of all the different oscillators, momentum indicators that I've found, RSI kind of works for me. I've used it for years. I now see a chart, I glance at the RSI, I immediately sort of think about where we're at in the cycle and what that pattern means. Find that indicator that's going to make sense for you and use it consistently. But you don't need to duplicate different indicators. You need to simplify more than anything. That's usually a good idea. All right, we're going to continue on with a couple questions here in a moment. I do want to thank partner to Market Misbehavior, Koifin. Koifin is a platform that I use often. I have a number of platforms that I have up on the monitor on my left all day, things that I'm using to follow the markets, analyze stocks, ETFs, indexes. Koifin has become something that's part of my daily process. What Koifin does is it was designed to be a much lighter and lower cost version of a Bloomberg terminal, which is thousands of dollars a month. I learned technical analysis on the Bloomberg terminal. I had one for many, many years. Giving it up was very, very tough. And I found Koifin was able to provide a lot of those things I was looking for. Things that I use here that I'm not able to get anywhere. Global economic data. If I want to dig deeper into a non-US market, great data capabilities. Digging into the holdings of an ETF is something I use literally every day, many, many times. So I bring up home builders and I look at the holdings and I can see how concentrated it is. I can see what sectors are reflected, which stocks in the biggest weight. So recognizing how concentrated some ETFs are, I think that alone has saved me a ton of headache and peace of mind in terms of actually understanding what bets I'm making when I buy or sell a particular ETF. If you're a financial advisor, I know a number of you are from the comments and questions that you've shared with me. Really great capabilities in terms of report writing, looking at client portfolios, creating model portfolios, creating presentation-ready reports you can share with a client and you can use as part of a portfolio review. Has a lot of really great features specifically designed for financial advisors. You want to learn more about it, go to marketmisbehavior.com/Koifin, or you can scan the QR code that you see on your screen. Because of my relationship with them, you can get a better deal a little more off than you would than by just going to their website. Helps me make Market Misbehavior awesome. So check it out, marketmisbehavior.com/Koifin. And thanks to the people at Koifin, and as always, for being great partners to Market Misbehavior. All right, Let's continue on here. For the Keller market model, have you thought about introducing a sideways yellow arrow as a way to demonstrate more caution? What about recommended market exposure given the model signals? I often get questions about the market trend model, as I called it, and I started getting more questions. And I guess that's a good thing when the good folks at Stock Charts a couple years ago, created a new version of the dashboard and agreed to have this as one of the widgets, which is really cool. So if you are a Stock Charts user, go to the upper right corner of one of these little widgets, click on more, and you can select Keller Market Model, along with a number of other ththings that are pretty awesome. There's a lot of really great capabilities, and they're working on making this whole page much more customizable over time, which I think could be pretty valuable as well. But this market model, I mean, it's very simple, and it was designed to be very straightforward. I designed it to be a shorthand, so at any point, I could just think about what is the trend in the markets on different timeframes that are most important to me, selfishly, right? The medium-term timeframes, like a couple months, the long-term timeframe over a year, short-term timeframe, a couple days to a couple weeks. And so by thinking of those different timeframes and just having a quick shorthand, it has been a great, helpful way of me just respecting the trend in the markets and just finding things that are in different trend phases, different phases. Could I do more with this? I've got a whole list of things to improve on this Keller market model and things to make, for a version 2.0 or 3.0. There is no neutral rating. It's designed to be very simple, so it's just binary, bullish or bearish. There are a lot of times when neutral could be helpful, and that's something I'll look at. Something within a certain range of the zero line, it turns into a neutral rating. I've just debated how helpful that would really be, because I kind of know the charts by looking at them a lot, but could be helpful. Could that help inform market exposure? For sure. And this is the conversation I tend to have with my market misbehavior premium members. What we do with the monthly chart review is actually run this market trend model on a bunch of things: U.S. indexes, non-U.S. equity ETFs, commodities, currencies, bonds, relative performance of stocks, of sectors versus the S&P, and I run the market trend model on that. I think I showed an example of that earlier this week. So that is certainly where I think a model like this can be very, very helpful, is helping you think about allocation and sector rotation and all of those things. It's not something I probably plan to build into that. It is something I continue to want to share with my market misbehavior premium members. So if you're looking for that level of detail about how we use this to inform positioning and investment decisions, check out the premium membership and see if that could be of help. All right, next question. The dollar is falling sharply. I was wondering, what is the cause of this devaluation? Also, what can happen if the dollar devalues too quickly? What sectors are at risk? Now, that is an interesting question. Actually, a number of questions with some interesting things to talk about. So let's look at the dollar together and talk about that, and then I will answer some of your questions on the potential, results of that, or implications, I guess is the better word. So one of the biggest, if not the biggest, change of the market environment from 2024 to 2025 was a dramatic turn lower in the dollar. And really, if you look at election day, which is back here, the dollar went higher into the beginning of January. But then once, President Trump took office, we've seen a consistently weaker dollar. Now, probably shouldn't be too surprised by that, because a lot of times, Trump and others in his administration talked about, being a fan of a weaker dollar for a number of reasons. Whether or not you agree that that's a good idea, to their credit, it definitely is having that effect, right? Things that they are doing are causing the dollar to go lower. So what does that really represent, right? So what is causing that move in the dollar? I would say from a technical perspective, pretty clear downtrend, lower highs, lower lows. We're below downward sloping moving averages. Look at a number of times we've tested the 50-day from below and failed. So certainly it's continuing in that downward trend. What's causing that? I mean, generally, when you see a dollar weakening in this kind of thing, I would argue it's a reaction to the tariffs that are being impacted. It's expectations of slower U.S. economic growth, eroding investor confidence, consumer confidence, capital, generally going away from the U.S. to other countries. We've seen non-U.S. markets being quite resilient, while the U.S. market was not so much at the time. Question marks about the dollar as a safe haven, that kind of is being reflected in a weaker dollar. Expectations of the Fed lowering rates, which basically is, usually creates a weaker dollar, because that's all tied to that weaker economic growth story. This is basically a lack of confidence in U.S. economic growth, and again, the dollar reflects on a lot of different things, but I would argue that is probably the main implication of what we're seeing here. Now, what does that mean? So, I guess a number of things that can mean. I mean, two general ways that I would think of this is just think very simply. Go back to like Economics 101. If you're a company based in the U.S. and you get all your raw materials from outside the U.S., chances are, tariffs are probably something you're thinking about very deeply these days. But also the weaker dollar changes that, right? Because your dollar doesn't go as far when you're trying to buy, goods from Japan or China or Vietnam or Brazil or wherever you're trying to buy things from, right? Whatever raw materials you're bringing in, your dollar's worth less than it was at the end of last year, and so that's making your supplies be a lot more expensive than they would have been otherwise. On the other side of that, the weaker dollar tends to be really good for companies that have a lot of revenues outside the U.S., right? A lot of big technology companies, if you're getting if you're selling a lot of stuff to non-U.S. consumers, when you convert those revenues back to U.S. dollars, it's converting to more U.S. dollars. So it's kind of a headwind for companies bringing they need to get supplies from outside the U.S. It's a tailwind for companies that have a lot of non-U.S. revenues. A lot of companies have both that they have to deal with, right? And so that's where I think everything I just said is one of the key things I'm going to be listening for with Q2 earnings that here starting in the next week or so. What are people saying about the weaker dollar? How is that impacting their business? What have they done to address potential tariff impacts? How do they see it impacting their top line and bottom line? Those are all questions that I'm sure will be teased out ad nauseum in this next earnings season. So that's how I would tend to think of the weaker dollar and what it represents, and some of the potential implications. I mean, this is a key story that is nowhere near done, I think, in 2025. All right, final question. Then that's 6 good ones here. In the market carpet, Uber is found in the technology sector. S&P has Uber in the industrial sector. Is this a stock charts mistake? Fair question. We talk about this a little bit, and I'll give you the quick version. And I don't even remember what day that was that we went into a little more detail on this, maybe Tuesday or something. But I did get a question in the chat on one of our live streams this week about sectors. I mean, the short answer is sector classifications are an absolute impossible task, right? There is no way to take just 500 companies like the S&P 500 and very cleanly and easily bucket them into any meaningful group that someone does not complain about. And I will tell you, I spent years working with index data teams, with market data firms, complaining to Bloomberg and Reuters and Thomson and whoever else would listen. Why are you using this sector classification? You're killing my report because you've got these stocks bucketed as technology companies instead of energy companies. That's totally wrong. And so firms like Fidelity, no kidding, create their absolute proprietary own sector classifications. We had our own Fidelity groups. We had our own way of determining what stocks were in what groups. We would change them when we wanted to. And it was done because for what we were trying to do with certain portfolios at a certain period of time, that just made sense. So they're all imperfect. They're all not great. Between you and I here on the live stream, for a number of years, as I was working full time at Stock Charts as the chief market strategist, if I ever saw a stock and I saw S&P bucketing in a certain way and I thought it should be different, I went to our data team and I said, hey, this doesn't make any sense. You need to move this stock over here. And they go, no problem. They do it. And still to this day, companies like Stock Charts, you change it. If you don't like how someone else is classifying them, you can change them. There's not as much consistency as you probably want. It is a very difficult thing to do. It is an imperfect science. So I think most people have just come to grips with the fact that there are a lot of different ways to classify stocks. There are no perfect ways to do it. I'm a fan of, if something doesn't make sense for what you're trying to do, if you have a way to edit it or tweak it or move something to a different sector so it makes sense for how you're trying to think about and talk about bets that you're making and why, I think you should just do that. Having said that, the most commonly used classification system in the U.S. is the S&P 500's GICS classification system. Out of all the ones that I've mentioned, it's probably the best I've seen in terms of just attempting to do things in the right way. And they have 4 levels from the top level sectors down to what they call the subgroups, the industry subgroups, and they're all classified in between. But again, platform like Stock Charts, it's not broken. It's just someone like me who had the ability to do so said, you know what? I think we should change this to the other sector, and here's why. And we would just do it. And so that's why, if ever things don't match, you can probably blame me. You're welcome to complain. I'm not going to change it probably because I probably have a good reason for it, but that's probably why there's a discrepancy if you compare to different platforms. Hey, fun questions, guys. As always, all of those questions came from people like you in the last week, watching the show during the live stream or watching the replay on our YouTube channel and just throwing questions in. Please keep them coming. It makes it interesting. I really appreciate seeing what you guys are struggling with and helping point you in the right direction. I hope you enjoy these Friday shows where we open the mailbag a little more deeply and get into some of the great questions. Have a fantastic weekend. I wish you safe, joyful, and fulfilling weekends. We'll be back here on Monday with some more market updates. Have a great one. And remember, it's always a good time to own good charts. Have a good weekend, folks.